Well, good afternoon and welcome to HYROX's weekly webinar, where we will talk about what we see happening in the global economy, in financial markets, and the world of wealth management, and how all of this impacts our decisions on the best courses of action for our and your investment strategies. As you probably well know, we invest our money in the exact same models as our clients, and we think that this defines the true nature of our prudent and disciplined investing strategy. Our discretionary management enables us to make quick decisions and execute them immediately for all of our clients simultaneously, which is especially important in volatile markets as we take advantage of the opportunities that avail themselves to us. I'm Scott Tomlinson. My partner and colleague, Paul Tepsich, the founder of HYROX, is also with us today, as is our financial planner and wealth forecast specialist, Bianca Tomlinson. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. If you are a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website under the Private Client Division tab. Let's start with a quick review, as we usually do, of our themes for 2017 and how they are evolving. We think that our strategy of having a tactical perspective to investing becomes even more important in 2017 because of the even greater levels of uncertainty imposed on us by a number of developing factors. Well, if the new U.S. administration is able to push forward some of its tax proposals and spending initiatives, it was expected that inflation might move higher. Bond market yields jumped early in response, but inflation-adjusted bonds have actually returned to pre-election levels, which tells us that we may not see all of this expected inflation anytime soon. Now, might that be telling of expectations of the new administration? We are still waiting on the details. Well, higher expected interest rates will increase the costs of borrowing, which in turn could present us with a whole new set of risks, with global debt levels still at record highs and rising. Now, if economic conditions continue to improve, it is expected that earnings will grow at an approximate rate of about 10.2% through 2017. However, this has been lowered from 11.5% at the beginning of the year. As I said, it is wait and see on details from the Trump administration at the moment, and Brexit may cost the UK over $60 billion equivalent. And it remains to be seen how the new populist revolution continues to play itself out in the upcoming elections in the Netherlands, France, and Germany. We'll come back to the latest developments on these shortly. Now, when we began our advanced approach to portfolio management back in 2015, we added a third model to the standard buy and hold balanced portfolio of equity and fixed income to try and find a way to add value to client portfolios by reducing risk and maximizing risk-adjusted returns. Our style is to wait for opportunity and be tactical about how we take it. Now, if you had bought the global equity ETF a year ago from 100% cash, you would have had an experience of close to 23% total return. But if you were bought in 2 years ago and held on, you'd only have experienced a 3.5% return. So you can see how a tactical strategy can be a benefit. The longer you're in, the smoother the curve, but at what risk? The higher goes the price, the higher the risk that it may come back down. And bond returns have been minimal in the last couple of years. So combining an equity and equity and fixed income balanced portfolio benchmarks after fees, you have had a lower than average return over the last 2 to 3 years. With a more risk-oriented approach, getting a higher return for the amount of risk taken, our clients have had lighter short-term returns, but well above average longer-term returns. And that's where we tend to put our focus. But as a reminder, historical returns are no guarantee of future returns. But at High Rock, as you all well know, we work very hard to provide our clients with the best possible risk-adjusted returns. We also believe that it is crucial that we review your wealth forecast on a regular basis so that we can ensure that your long-term goals are in line with your portfolio strategy, and our forecasts for your net worth into the future are up to date and heading in the same direction as your goals. Okay, let's turn over to the inflation front. Now, inflation data remain below target on a global scale, and although expectations continue to be for higher levels of inflation, at the moment, we do not see any policy changes at the central banks. And as you can see, March, starting with the Bank of Canada, March 1st, we have a slew of central bank meetings and policy announcements to come, so we'll keep a very close eye on that. After 4 years of commodity price deflation, prices started to rise again at the beginning of 2016, about a year ago, but recently they have begun to stall out. But U.S. total CPI rose 2.5% year over year in January. Now the Fed targets the core personal consumption expenditure price index, which was below their 2% target at 1.8% in December. We'll see that data in a couple of weeks. And that may have some influence on the Fed's decisions for March, but we don't think it will be significant. Wage growth is important. Inflation is limited in its ability to progress without wage growth, and wage growth appears to be stalling most recently. Now, inflation-protected bonds peaked in December, and as I said earlier, have retraced most of the post-election gains. As bonds tend to lead other financial markets, this may be notable as far as reduced inflation expectations are concerned. It may also be a reason for the Fed not to be raising rates at their next meeting. And the U.S. yield curve has also flattened from its peak steepness in the post-election period. Well, in Canada, there's been less growth in inflation, and while bond yields have tracked U.S. yields higher, they have not done so to the same degree. Longer-term borrowing costs have risen, but without the desire for the Bank of Canada to raise interest rates anytime soon, short-term rates remain lower. Now, for borrowers, this means that staying variable remains the best option for the time being. Well, on the debt front, U.S. households are borrowing more. Car loans and student debt have been leading the debt levels, which are getting back to the 2008 peak. This is something that we have to continue to monitor, as well as the global situation in debt, which, as we pointed out, has hit new record levels up very recently, and certainly is a focus of the International Monetary Fund's at this particular point in time. Over to the earnings front. Well, expected earnings for 2017 have been reduced from 11.5% year-over-year growth at the outset of the year to 10.2% at this particular moment in time. However, S&P 500 prices continue to rise on Trump and global economic optimism. Looking forward, prices continue to outpace expected earnings. And with lower earnings expectations and higher prices, the price-to-earnings ratio has jumped to 17.6 times, which is its highest level in about 14 years. Now, while the 10-year average remains at 14.4 times. What that means is that earnings will have to grow by about 20% or more than what is currently expected to bring the ratio back to its 10-year average. Or, on the flip side, the S&P 500 will need to correct by about 20% to the downside. You have to ask yourself if you want this kind of risk in your portfolio. Another of our metrics of value, enterprise value to EBITDA, shows stocks to be as expensive as they were at the time of the dot-com bubble. And if we look at the price to sales ratio, we can see that the same circumstances exist there as well. Well, there's been plenty of action on the geopolitical front over the course of the last couple of weeks. And while we wait and debate the details of the Trump fiscal policy measures, the skirmish between the media and the president has heated up. And the European Commission President Jean-Claude Juncker has suggested that the Brexit price tag might be close to $60 billion equivalent. And a win for the far-right presidential candidate, Marine Le Pen, would spell the end of the EU, but the French are not crazy enough to let that happen, apparently, insists European Commissioner Pierre Moscovici. So here at HighRock, with all of the upheaval, we will continue to monitor event risk and price valuation, and we will add or reduce holdings in our models as opportunity presents itself, and by preparing our strategies with continued deep levels of research, as we did last year, keeping in mind that our tactical approach allows us to add value and reduce risk to give us the best possible risk-adjusted returns. An example of this, some trades we did back in mid-November that involved selling fixed-rate perpetual preferred shares and buying fixed-rate reset preferred shares to coincide with long-term interest rate adjustments and we did this for all of our clients simultaneously. This is just one example of how being tactical can reduce risk and benefit return in a portfolio. And of course, we have to keep an eye on market correlations. And this is where I'll ask Paul if he has anything to add this week.
Okay, thanks, Scott. Just in the bottom part of that chart, you can see the blue line where it's above zero is green and below is in red. What this means effectively, what we're looking at here in the top half of the chart, the white is the TSX index, and the green line is the 10-year Government of Canada yield, the bond in a yield format. So what the correlation in the bottom half shows us is that we're now getting back to a correlation that actually matters for us, one that if stocks go up, bonds should go down in price or up in yield. So that is how we would normally see the correlation between stocks and bonds. So, and I mentioned this, I think a few weeks ago, but we did buy some more 10-year Government of Canada bonds when the correlation started going from zero and started moving back up towards where you see it today at 0.52, which is still not super high, but it's moving in the right direction. And really what this does for our overall portfolio, when the correlation gets high to where it should be, it means that if stocks do sell off, bonds will now respond the way they should respond, i.e. bond prices should go up. So it provides a natural and passive hedge to our portfolio. That's maybe a little complicated, Scott, but there is method to the madness, and this is some of the analysis that we do.
And actually, in a simplistic way, it is adding what we would classify as a balance to our portfolios in order to hedge ourselves against the risk the higher risk that the stock market's presenting right now.
Right. And I guess we could add that back in September, as it was starting to go red, in the first, on the far right, in the first red bucket, that's when we sold some of our 10 and 30-year government bond positions. So that actually helped us out a fair bit, especially given the U.S. election where rates backed up substantially.
Excellent. Thanks, Paul. Thanks for your commentary. It's great. It's great to get the other perspective, not just mine, of course. All right. Well, that's it for this week, trying to keep them short and sweet so that we don't take up too much of anybody's time, but we do want to thank you for taking the time out of your busy schedules to tune in. If you do have questions or concerns, please definitely feel free to email them to us. We'll be back with our next update next Tuesday. But until then, this is Scott Tomlinson. On behalf of my colleagues Paul and Bianca, we want to wish you all a great rest of the week. We'll see you next Tuesday.